Every Kenyan business must prepare formal financial reports at the end of its financial year. Think of them as a detailed summary of your company's financial performance and position. In Kenya, preparing this is a crucial requirement for both legal and tax compliance. They are essential for filing accurate returns with KRA and for securing financing from banks or investors. A complete set of annual accounts includes 5 key components, prepared according to the International Financial Reporting Standards. The statement of financial position, or the balance sheet, is a snapshot of what you own and owe. The statement of profit or loss shows your performance over the year. The statement of cash flows tracks actual cash movement, which is vital for lenders. Finally, the statement of changes in equity and the notes provide crucial detail and context. The requirement to prepare and file annual returns depends on your business's legal structure. All private and public limited companies must prepare, audit, and file accounts with the Registrar of Companies and KRA. Limited liability partnerships, or LLPs, also need to prepare accounts that give a true and fair view. Even sole proprietorships must prepare accounts to determine their taxable income for KRA. Specialized entities such as NGOs, SACCOs, and public sector bodies also have mandatory filing requirements with their respective regulators. While most companies require an external audit, the Companies Act provides an exemption for small companies. To qualify, your company must meet at least 2 of the following 3 criteria. First, an annual turnover of not more than 50 million Kenya shillings. Second, total assets of not more than 20 million Kenya shillings. And third, not more than 50 employees. Even if you are exempt, remember you must file and prepare accounts for tax returns. For a company with a financial year ending on December 31st, planning is key to a smooth process. In January, the internal accounts team should finalize all bookkeeping. By February, the accountant prepares the draft financial statements. February to March is typically for the external audit. In April, the board of directors reviews and approves the final audited accounts. By June 30th, the company must file its corporate tax return with KRA, uploading the audited returns. To ensure a smooth year end, here is a practical checklist for business owners. First, reconcile all bank accounts and confirm your accounts receivable and payable lists. If you hold stock, conduct a physical inventory count and update your fixed assets register. Gather all required documents like bank statements, loan agreements, and statutory payment records. Finally, schedule the external audit early and agree on a timetable. A crucial concept to understand is that the profit in your accounts is rarely the same as the profit KRA will tax you on. You start with your accounting profit before tax, then you must add back non-deductible expenses like depreciation, fines, and general provisions. After that, you deduct allowable items that aren't in your P&L. Most commonly, capital allowances on your assets, which replace depreciation for tax purposes. The final result is your taxable profit, which is used to calculate your corporation tax. So what are capital allowances? They are KRA's version of depreciation. Instead of deducting depreciation from your profits, the Income Tax Act allows you to deduct a percentage of the cost of certain assets. This applies to assets like machinery, computers, furniture, and vehicles used in your business. The specific rates are set out in the Act and are designed to encourage investment in business assets. Many businesses run into common avoidable pitfalls. Here are a few to watch out for. The most obvious is late filing, which leads to heavy penalties from both the registrar and KRA. Poor record keeping is another, which can lead to disallowed expenses during a KRA audit. Be careful not to mix personal and business expenses, a classic error in owner-managed businesses. Finally, failing to make key disclosures like related party transactions can have profound governance implications. Ultimately, preparing annual accounts is far more than a compliance burden. It is a vital exercise in business health. Timely and accurate reporting is the bedrock of sustainable growth, enabling access to finance and fostering investor confidence. The key is proactive planning and meticulous record keeping throughout the year. Your next step: review your current systems, engage with a qualified accountant early, and use your accounts to make smarter business decisions.